You've probably been told that to truly test a trading strategy, you need to be a programmer. Like, you absolutely must know Python, PineScript, or how to build these massive, complex algorithmic models, right? Otherwise, you're just trading blind. Well, actually, scratch that. That is completely false. You absolutely do not need to write a single line of code to figure out if your strategy actually works. Most traders, they really just need a structured way to review historical price action, test out their rules, and track the results. So in this video, we're going to break down the definitive step-by-step masterclass on exactly how to backtest manually and how to avoid those deadly traps that make most backtesting totally useless. So if we aren't writing algorithms, how exactly do you review historical price action? I mean, ask yourself right now, how are you currently testing your ideas? Because if you're just opening up a chart, zooming way out, and kind of eyeballing a few setups where the market happened to move in your favor, you are setting yourself up for failure. Big time. To backtest without code, you really need a structured manual framework. You need an environment where you can execute trades on historical data exactly as you would in a live session. Okay, let's dive right into this because we need to completely shatter the illusion of what I call fake backtesting. Fake backtesting is when you just scroll left on your chart, spot a massive breakout, and tell yourself, oh yeah, I definitely would have bought right there. Well, sure, that is pure hindsight bias. You already know what happens next. Real backtesting, on the other hand, it relies on tick-by-tick visual replay and strict, unbreakable rules. You aren't predicting the past, you're navigating the right edge of the chart, literally candle by candle, dealing with the exact same uncertainty you face when your hard-earned cash is on the line. So here's our roadmap for today. First, we'll tackle the backtesting problem. Second, defining your strategy clearly. Third, using chart replay. Fourth, tracking your data. Fifth, avoiding common execution traps. And finally, number 6, finding your true edge. Number 1, the backtesting problem. Countless traders literally blow up their accounts on untested strategies simply because the idea of coding feels just way too intimidating. But to see exactly how your setup performs before risking a single real dollar, you have to remember this golden rule. The key is not speed. The key is consistency. Sure, algorithmic testing might run 10,000 trades in 2 seconds, but manual testing, it isn't about rushing. It's about flawlessly building your own pattern recognition and gathering really high-quality data. Number 2, define the strategy clearly. Listen, if your rules are vague before you even open a chart, your entire backtest is completely useless. You have to write down your exact criteria. First, pick just one market and one time frame. Don't try to test a breakout strategy on the 5-minute S&P 500 and the 4-hour Bitcoin chart at the exact same time. It's too messy. Keep the variables isolated. Second, define the exact setup that confirms your entry, where your hard stop loss goes, and your precise profit target. And third, set absolutely strict risk management. So the crucial point here is, how much do you actually risk? The mathematical imperative here is risking exactly 1% per trade. Now, you might be wondering, why 1% and not, say, 2% or 3%? Well, it all comes down to drawdown math. A trader with a 50% win rate is almost guaranteed to face a 10-trade losing streak eventually. It's just statistics. At 1% risk, 10 consecutive losses cost you roughly 9.6% of your account. That hurts, for sure, but you survive. At 3% risk, those same 10 losses wipe out over 26% of your account. You need a massive gain just to get back to break even. So your backtesting absolutely must reflect a survivable 1% risk model. And how many times do we actually need to test this setup? 50 to 100 trades, minimum. You absolutely cannot judge a strategy after just 5 or 10 examples. No way. A strategy might lose 6 times in a row purely due to normal market variance. You need a sample size of at least 50 to 100 manual trades to truly see those statistical patterns emerge across different market conditions like, trending, ranging, and high volatility environments. Number 3, use chart replay. Using a historical chart replay tool, like the one built right into TradeZella, allows you to step forward candle by candle. You are totally blind to the future. You have to treat each historical setup exactly like it is happening live. When your entry criteria flashes, you mark your entry, your stop, and your target based only on what you can see right then and there. This forces you to feel the hesitation, the waiting, the whole psychological and mechanical discipline of the trade. It perfectly bridges the gap between theory and reality. Number 4, track and review data. Now, what's really interesting about this concept is how you review your data. You must track R multiples. This is a framework champion traders use to evaluate performance. The R simply stands for your initial risk. If you risk $300 on a trade and hit your stop loss, your outcome is a -1R. Believe it or not, that's a good loss because you followed your rules. But if you ignored that stop loss and lost $1,800, well, that's a -6R. That means you completely broke your discipline. On the flip side, targeting a positive 2.5R or higher is exactly how you build a deeply profitable system over time. Tracking R multiples strips away the dollar signs and forces you to look at your actual execution quality. When you meticulously log all these backtested trades, you start generating some serious analytics. You really need to read these metrics closely to see if your strategy is realistic. What's your win rate? What's your average win compared to your average loss? What is your profit factor? Look, if your profit factor is a 2.8 on 42 trades, you have a massive edge. But if your backtest shows a huge maximum drawdown, your strategy is just way too risky for live trading. The numbers will literally tell you exactly where the strategy is strong and where it's completely broken.
Number 5. Avoid common mistakes.
Okay, so these are the cardinal sins of backtesting. A strategy can look perfect in theory and still fall apart right here. Never, ever change your rules halfway through a sample set. And be honest, do you move your stops to give a trade more room? Doing that totally invalidates your data. Also, using mental stops, which, let's be real, we all know is just trader speak for hoping it turns around, or ignoring the reality of fees, spreads, and slippage, that will instantly destroy your live account. Oh, and don't just cherry-pick the perfect-looking examples to test. Test the ugly ones, too.
Finally, number 6. Finding your edge.
And this brilliantly illustrates our final point. Backtesting is a pretty sterile environment, right? Which is exactly why it absolutely must be paired with a deeply structured daily trading journal like TradeZella. By capturing your daily trade adherence in a calendar format, you can seamlessly compare your theoretical historical edge against your real-time live performance. Think about it. If your backtest says you have a 60% win rate, but your live journal shows 30%, you don't have a strategy problem, my friend. You have a psychological problem. I really want you to burn this quote into your memory. Backtesting proves whether the strategy has an edge. Journaling proves whether you can execute it. Past data gives you the confidence that a setup has serious potential. But tracking your behavioral compliance, like did you actually follow your rules today, that is the only thing that proves you have the discipline to extract money from the market consistently. Let's bring this all together with a final provocative question for you today. Can you execute your edge consistently? Are you ready to stop guessing and start actually proving your strategy? If you want to leverage the exact chart replay, backtesting, and analytics tools we walked through today, you can get 20% off TradeZella right now by using the exclusive link in our description. Seriously, think about it. Are your current trading losses the result of a bad strategy or simply a lack of hard, tested data? It's time to get in the lab, do the work, and find your edge.